Welcome to Trading Lounge and the European indices for the 13th of February, and starting with the UK this time. And in the bigger picture here, from the top here close to the 8,000, a major trading level 8, down to a medium level which is 6,500. A medium level is halfway between two major trading levels, so the trading levels are Fibonacci as price ratio, so 5,000, then 8. So 1, 2, 3, 5, and 8. So this 6,500 is halfway between 5,000 and 8,000, and it's unassuming number, 6,500. But you'll see it in stocks too. It's $6.50, $16.50, 65 cents, 6,500 where we are here. Still, the pattern here is we can look at it in two ways. We can look at it as an A wave, a B wave, and 5 waves down for a C wave here, or we can look at it in terms of wave 1, wave 2, wave 3 here, and then wave 4 here, and then moving down for wave 5. So this wave 4 here would pull back to the wave 4 of 1 lesser degree, which would be here. Or the 38.2% retracement level, which is a bit lower, but the wave 4 of 1 lesser degree I find is more valuable. The 38.2% is at the 7,000 here. The wave 4 of 1 lesser degree is more potent because it's a mirror reflection of where the volume occurred. That's where the event took place, so to speak. So this little move up here, if it was a wave 4, then we'd look at it as an A and a B and a C wave up to this point here, and we can possibly have one more new high here as well into the 7,200 here. So a 72 number here, quite important. As you can see, it's the balance line through here. So yeah, otherwise it's wave 1 up here, in line with the US markets, and then an ABC for wave 2 here. So on the 4-hour chart, we're looking at it like this. Now, I had it as 3 and 4 here and going up for wave 5 to this point. But I have to say, if this top here is breached, then we're going to make a new high here. If it's not breached, then we can look at this as an A wave, B wave, and we can look for a move down from that point. Okay, so let's just go to the hourly chart and pick that up. So if this rally here was higher than the 61.8% from the top here, well, realistically, I think that we need to put this actually here on that high. I need to check that on the cash market. So so an A wave, an A and a B and a C wave to this point here. So if this is breached here, then we need to be on the long side from that point. Well, even being on the long side is not going to get us that far really, but we could go long at that point. This 72 number here will be critical. We'll see the market, if it moved up here, then it would move up only to fold back here. Okay, then this wave 5 here would basically go copy that and put that there. So in shorting this, we were looking as normal as picking up the low here and the first pullback here, and that would give us our line through here. So with trend lines like this as well, it's just they're like other trend lines like this here, migrates from being resistance to support. It's the same over here. So if we've got a trend line going through here, market come down, market bounce off it, market come through it, market bounce back off it, and then drop. Now you always need to be a little bit mindful, because sometimes you get a second retest of that and then down. So be careful about where you put your stops and how you handle that. You know, you would only really want to be out of the market if you were short here. If you were short here, then, or anywhere on this side of the line, then you would only exit the position if this trend line here became the support again. So the other thing here too is that, let's just, this move to here, we drop this into here. This will give us our Wrong tool here, sorry about that. Or was it? So this is our 50-60% retracement level. So we can say that this 7,100 here is going to be the support. It's pretty obvious, but just nice to know the ratios as well. So yeah, this can be a bullish move up, but if it breaks, well, if it breaks this low here or this one here, which brings us back into the 7-1 as well, then it makes that a corrective rally at that stage. So yeah, I mean, you can short this through here, but just make it a very small position, because it might just be an A and a B and a C coming back down to this position, then moving up from there. So really a short position would have to be really under the 7,100, and the same thing here as well. If it's going to move through here, it's going to come down, it's going to bounce off that, and then it's going to come back and like a ball bouncing, have a lower high and then drop through and come back and then down. So then you've got your reference point low at that stage, and that's the safer trade. So it's always nice to get a small position, you know, a very small position above, and then look to build into that there. So this is much the same for the CAC. Well, I've got the CAC here as well, if I can just bring that across, because the DAX is a little bit different. So here, this little move up through here, we were looking at this being 5 waves down here. The move up here can be counted as an impulse wave. It can be counted as 1 and 2 and 3, triangle for 4 and up for 5 here. So the other way to count this would be corrective as an A wave, a B wave and a C wave up to this point here. So if also too, if we see a new high above this one here, above, so the program's just resetting itself, it's as the Australian Open happens. So if we see a move above here, then we know that we're going to be having another high in place here as well. And then we'll have to shift this over to this point here. This can also be, well, not so much wave 4. Let's just have a look at the, if we have a look at a bearish picture for the French market, it would look like this here. So this is a weekly chart, and we would look at this from this low here as wave 1, ABC for 2 here, and then 1 and 2, and then 1 and 2 and 3 and 4 and 5 for the 3rd, the 4th, the 5th here, an A and a B and a C here for, well, a little bit different than that, but wave 4 and wave 5 here. And then we would need to look at this here as wave 1, an A and a B and a C for wave 2, 3, 4 and 5 down here. So this is pulling up into the 50-60% retracement level, and also too where these little, always like to look where the most open and closes occur, so I can see them straight through there. So obviously that's an important level there, so that can be brought on through into this space here. So but this does look rather impulsive up here. So the other thing too, if we're looking for a wave 2 here, these normally come up to the 50% level, then drop back as an ABC, and then come up and hit the 61.8% and then down from that point. So we'll need to be mindful of that of that scenario there as well. And of course, this is all a dance at the major trading level 5 here. So yeah, the levels are really handy. You just need to put them on your chart, because otherwise you won't see the value of them. So it's a major trading level here, and so on. But you can always look on our website for a free course on the trading levels. It will only give you the free course on the major, the minor, the medium, and the minor levels, but also explain the patterns that occur at the levels as well. Okay, let's have a look at the DAX. So with the DAX here, yes, we can also look at it being wave 4 here, like the FTSE. Coming back up to the wave 4 of 1 lesser degree. It's moved past its 38.2%, but that's okay. This is also a medium level here of 11,500, halfway between 10 and 13. So it's significant. And you know, if I was trading stocks and this was $11.50, there's no way I'd be buying in here. I'd have to wait for this to have a setup over here. I'll just go find another stock, and that's why I prefer stock trading rather than indice trading, because, well, it's less leverage, so it's the blades are not as sharp, and with stocks you've just got more options. I think, you know, you've got you've got your sectors, and then within those sectors you've got your leaders and your followers, and yeah, there's just much more variety in terms of finding nice solid trade setups, and because the leverage is is less if you're using, you know, options or CFDs or spread betting and so on. Yeah, you're not borrowing as much as such, so just a little bit safer. And also trading end of day. If you're not making money intraday, then definitely switch to stocks end of day. It will save yourself a lot of stress, and you'll be able to think clearer. You'll be able to find more opportunities, and so on. So this move up through here, it's a bit of a scraggly old sort of count, and we've got two counts here, so we can have wave one on the top here where this is, and this would be an A wave coming down, a B wave coming back up, and then a C wave coming down into this space here. So that's one way. The other way to look at this is that having wave one here and wave two here. So either of these counts is valid. I don't know which is which. We just need to be a little bit mindful, but let's go in and have a look at these guys. So yeah, as I just explained, we can call wave one top in here, and an A wave here, and then a B wave coming into here, and then a C wave here. This move up through here, we wouldn't want to see it moving any higher than going into this space here of 11,200. Above that, then it's bullish. Then above that, we would need to look at, this is wave one over here, an A wave here, a B wave here, and a C wave here. The trouble with this being a C wave here is that in most cases, I mean, this was news driven, but in most cases when a market moves up and has an A wave, the A wave is the sharpest, then the B, and then the C is on more of an angle in relationship to wave A here. So that's why it looks like wave A to me here. But anyway, let's see. The ratio here is, well, you can see that there is just in here. So as I say, we don't want it coming. We don't want it coming anywhere above the 61.8% or above the 11,200. And the 11,200 is important because it's really locked all of this in here. So this would be a retest of supply meaning sellers. So this is the critical point here, 11,200. So that's a minor level. So you'd have to go to sub levels next. So sub levels are 180, 172. And 165. That would be group 2 in there. But let's go in and have a look at this. Now, it looks a little bit sort of awkward here, but if you look at the cash market, it's just a straight, nice impulse wave of 5 waves from the low to that high here. So we've either got this here, if I can just borrow these for a second, copy that. It's either got this as an A, B, let's just give it one more high here. So it's either an A and a B and a C to here, or it's 1 and 2 and 3 here, and then 4. So we need to really just wait to see what occurs here in terms of wave 4 here. So what we can do, or what you can do next, just to help refine this a little bit, is we need to wait for this top to be in place here. So we need to take the low of this here, and then wherever that high comes in, let's just put it on the 61.8% there, then the 38.2% is here back at 11,100. And also this would be the wave 4 of 1 lesser degree here. So knowing that, that means that our short trades, if I could just copy that, can go under here. So that means that market would come down, bounce off here, eventually come through here and pull back. So this would also bring us into group 2 here as well. So group 2 is, subgroup 2 is 80, 72 and 65. Okay, so once the 72 here, 72 in here if I can find it, once that becomes the retested resistance, then that's the optimal short to the downside at that point. And then you would also look to add to this trade on the short side once the midpoint here, the 50, becomes the retested resistance. And you know that there's going to be a bounce at the 11, so you either exit at the 11 or you accommodate that. But yeah, because we've only got 3 waves up here, if it drops from here, then we'll be going below these lows here. So we'll be going further down into this space, down into this here. So you would hold through the 11,000 or sell, cover some of the shorts here and sell the bounce. You know, you don't have to be perfect when you've got positions in there. Just get the strategy right. We were looking to go short below this low here, so we don't need that one here now. And we're also looking to go short on the breach of, well, the low and this, when this was breached here as such. So we don't need that now at that point, but yeah, I'll just move it. But what we will do is we'll just put a thin trend line through here, and that will be a little bit helpful within that case. And also too, we're going to need to look at the MIB as well. So so once again here, I've had this as a top here as wave 1 and an A wave here and a B wave here. The problem with this is that it's moved above the 61.8%. So we were going to go short here, and we're also going to, I also had a green line going through here, but that hasn't been breached either, so we don't need that. Now, there's a couple of different ways we can look at this. We can look at this with wave 5 sitting over here, and then this would make wave 4 here as an A wave, a B wave, and a C wave here. I don't know, so I'm just going to put it back to the way it was for the time being, and let's just see how this rally pans out through here. I'm still not interested in going long here until we've got a nice solid support here. Sorry to be a bit of a drag, but what I want to see, whatever happens, we want to see the first high above the level. Once we got that in, then the market's going to come back and test it. And it's after that test and that correction that gives us, you know, this would be the A, the B, and the C, the A, the B, and the C here. After we've got that, after we've got this here, then we can move into the market. Then it will be safer to move into the market, because it's a game of accumulation and distribution. So the correction has a lot of facets in it, but in a nutshell, it's part of the accumulation process, and the distribution process is the trend. So we need to be based off this here. We need a setup here. We also want that number there as the support, not the resistance, because it just faces you with too much risk. Yes, sure, look, you know, in hindsight, you could say I've gotten in here and then added over here and so on. But I've just been, you know, when you run the numbers on those sort of things, it just doesn't sort of pan out. It's better to use the numbers. So you trade to the numbers, you get out, you wait for that number to become support, and you get back in, and you're much safer. And that way you miss a lot of the noise, because these big numbers are going to bring a lot of noise with them, and you just get locked into them, you know. I mean, they're good for options trading if you want to burn time, you know, and you're on the other side of it, then they're fantastic. But for being directional, we need to move with the volume. The volume creates the price, so the price is just a shadow that we chase. So we need to know where the volume is in the market, and the volume we can read the volume, but the volume will always tell us that having something as support or resistance. And most trading systems that are reasonably successful will be based off support and resistance. They will be something that you may not see, but they'll be in the shadows of whatever that system is, volume based. So the price is half of the picture, the volume is the other half of the picture. and the indicators are just flags to keep you swimming in the right direction. Alrighty, cheers.